If you're looking to buy Palantir stock or interested in how the company is doing, then please keep watching this video because today we're going to take a look at the company's recent news, the market's treatment of the company's price action and the fundamentals results, and what are the technicals telling us. We're also going to come up with a trading approach given the current circumstances. As the market remains very volatile, we should always be careful about which stocks we pick and choose, as well as their individual timing and exposure for entry and exits. Before the video begins, if you would like to see more stock analysis videos like this one, please remember to like, comment, and subscribe to my channel. Over the past few days, Palantir initially reached the $20 level, but ultimately gave away to the selling pressure of profit taking and ongoing news. I believe that Palantir will eventually be able to go beyond this critical psychological level, but given how the market has been over the past few years, this may still take some time. Recently, Palantir finally won over the NHS contract in the United Kingdom despite waves of criticisms and doubts that have lasted for many months. In addition to its more typical hunting grounds, the company also made a move on the artificial intelligence narrative while it is new and fresh in people's mind, in addition to its now positive profit margins. So far, the market has received these news very well, taking them as actual vectors by which there will be an increase in demand for the subsector and, more importantly, I believe, for the shares of Palantir. Generative and large language models have been very popular over the past few months, as it remains one of the first times that the public really realized the potential of artificial intelligence. So those large models, of course, require a large sum of analysis over a huge quantity of data, a domain in which Palantir would have good advantage. And the market also believes that Palantir may be able to develop its own models and platform thanks to the data it has, generating more revenue streams with the private and public commercial partners. I mean, after all, one of the key advantages that Palantir really has over many of its tech rivals is its relationships with large entities who have access to very deep pockets and almost an unlimited quantity of money and resources as far as a company is concerned. Palantir is certainly a company known for the quality of its work and of a certain reputation in the sector, and this would be able to play in its favor when it comes to client acquisition and retention. With that being said, let's also take a look at the technicals of the stock. The trading volume of Palantir has recently been around 68 million shares versus the average volume of 72 million shares. Over the previous 52 weeks period, the price fluctuated between $5.84 and $21.85. The volume of shares traded tells us how many shares are being bought and sold at any given point in time, and if there's enough liquidity to support a trading strategy. If the float is thin, it will be very easy to influence the stock price, but low liquidity could also mean that the demand could be limited. When we compare the current volume against the average volume, there might be the possibility for trend reversal or breakthrough if the difference is very large as well. For example, if the stock were to break through, the current volume would be significantly higher than the average volume. The market cap is currently around $43 billion compared to an enterprise value of $15 billion. As we compare the current price to the historical price fluctuations, the stock is 36% higher than the 1-month low, 44% higher than the 3-month low, and 237% higher than the 52 weeks low. On the options market, which often gives us a hint about the market sentiment of where the stock price is probably going to go next, the implied volatility is around 53%, compared to a historical volatility of 74%. The put-call volume ratio is around 42%. It is normal for many stocks to also have a higher put option volume than what they deserve because many institutional investors hedge their long positions by buying put options. The most recent volume of options traded is around 337,000 contracts a day versus the 30-day average of 351,000. In terms of open interest, the most recent volume of open interest is around 3 million contracts, compared to a 30-day average of 2.9 million contracts. In terms of the shareholder structure, institutional owners have about 40% of Palantir, likely as a result of institutional ownership and sometimes short-selling lending. The biggest shareholders include Renaissance, Vanguard, and BlackRock. It's always an encouraging sign to see a significant institutional holding into any stock's equity, because this offers a layer of stability and a token of trust in the medium to long term. It means that the market is confident that this company in particular may be able to actually deliver on what they promised. I personally believe that a minimum threshold of around 25 to 30% for institutional ownership is a good sign to go for, although there are many other exceptions to this rule, as there will always be great companies, mostly owned by retail traders. The current short interest is around 8% of the total float, 53% of which are coming out from the dark pools. Typically, if the short interest is above 15%, the total volume and a significant portion of the short volume comes out of the dark pools. This can suggest that there are institutional positions taken to short the stock, and that there would be potential for a short squeeze. So right now, the global markets are facing a complex interplay of factors that have the potential to significantly influence the equities worldwide. In this speculative analysis, I believe that the consequences of the global inflation, surging commodity prices, and decline quantitative easing, as well as the rise of inflation rates or interest rates, plus the geopolitical instabilities, are going to play a significant part. The increasing inflation rate has been putting pressures across the globe, threatening the purchasing power, raising the input costs, and impacting corporate profitability. Companies operating internationally may face challenges in managing rising production costs and also to sustain profit margins. Those dynamics could trigger market volatility as investors adjust their risk-return expectations. The upward trajectory of commodity prices, including energy, metals, agricultural products, have been having far-reaching implications for various sectors of the global equities market. The companies heavily dependent on these commodities may experience squeezed profit margins, potentially affecting stock valuations and investor sentiment. The reduction or the end of QE's quantitative easing measures by the central banks worldwide may have resulted in reduced market liquidity. So this in turn could lead to higher borrowing costs for companies seeking capital, which may also discourage investment activities or will. The elevated market volatility plus the reduced investors' appetite may also continue to occur. Now, the central banks around the world are tackling this delicate situation of balancing the inflation rates with the economic stability and, if possible, growth. Central banks opted for aggressive interest rate hikes to combat inflation. Borrowing costs for companies have been rising, which has also slowed down business activities and also fueling the market's volatility in terms of the equity prices. Now, ongoing geopolitical tensions, including trade disputes, political uncertainties, and social unrests, will inject an additional element of volatility into the global markets. Investors may adopt a cautious approach, shifting towards safer assets, impacting the equities. Additionally, the escalating conflicts may disrupt supply chains, negatively impacting the performance of international companies. Given the interconnectedness of global markets, the aforementioned factors have reverberating effects on the US equities market. Companies with significant exposure to international market may face a lot of headwinds resulting from the economic slowdowns, disrupting the supply chains and the currency fluctuations. But nevertheless, the US market is known for its resilience, and the diverse sectors may attract investors seeking safe havens. So, really, the current landscape is characterized by global inflation, surging commodity prices, reduced quantitative easing, rising central bank inflation rates, geopolitical instabilities, and also ongoing lack of certainty regarding growth. While the US market may exhibit relative strength due to the safe haven status, it's going to remain interconnected with the global economic landscape. For long-term investors, these conditions may offer opportunities to identify undervalued companies with strong fundamentals and international diversification. With that being said, short-term trades should be approached with caution because of the increased volatility and uncertainty. And also, we should be careful when assessing individual companies, sectors, or regions. My recommendation for Palantir is to have an existing position first, and then to slowly accumulate its shares over time. I believe that the timing at which Palantir may take off would coincide with the decrease in the interest rates, so we may still have a few months or even a few years ahead of us. Overall, it is a stock worth having in your portfolio, and I believe that it's going to blossom in the long term. The maximum recommended allocation of capital I would go for is around 3 to 5% of your portfolio.